purely about the amount of liquidity that is really being thrown into markets. That's why Bitcoin is at a high. That's why gold is not far off its high. That's why probably those particular assets are going to move a lot higher in the future. We're in a world which is dominated by the need to fund governments. It's a fiscal dominance world, if you like. Monetary policy is a slave to that. It's a world where you've got to think seriously about how to protect your wealth. But like all cycles, they end. And that's the challenge we've got to start to think about, because without any question, we're late in the cycle. How do cycles end? Cycles end in two ways. One is that.
Meet Michael Howell, the CEO and founder of Cross-Border Capital, a leading independent research and investment firm based in London.
With over 40 years of experience in financial markets, Michael is an expert in liquidity trends and capital flows, helping institutional investors navigate the global financial landscape. Before founding Cross-Border Capital, he held key positions at Salomon Brothers and Baring Securities.
Yeah, almost 100%. I think that they're in the business of kicking the can down the road. The implications of short-dated debt financing, it's not just about the interest cost, it's about the long-term monetary implications. They clearly want, stablecoin, private sector stablecoin, to be an established pillar of the US financial system. Now, there's been a lot of wild talk about stablecoin as replacing or something akin to the eurodollar markets in the 1970s. Forget that, because stablecoins are not in that same position. They're not banks. They cannot create credit per se. They're much more akin to. So if banks are losing deposits to stablecoin issuers, banks are then losing their ability to create credit. That could mean we've got MMT, although everyone denies it. But that's exactly the policy they're following.
Hey guys, I just wanted to let you know I published a new book, The Bitcoin Enlightenment, co-written with my buddy Daniel and none other than Mexican billionaire Ricardo Salinas. It's a deep dive into the monetary system and its future. In it, we make the type of connections that go beyond what you'll hear from your average Bitcoiner, MMT advocate, or macro pundit. So grab your copy on Amazon today. You'll find the link in the show notes. And now on to today's show. Hey guys, welcome back to Less Noise, More Signal, and also welcome back, Michael, to the show. Cool to have you with us today.
Great to be here. Thanks for the invitation.
Yes, great. So cool. We've had you on a couple of months ago, and I really think I need to get you back on with everything that's been going on. I want to talk about liquidity, obviously, about the Stablecoin Act that I think you've written on as well, then all the fiscal shenanigans that's sort of going on and chipping away at the heart of U.S. institutions, I would even argue, and then also maybe some investment talk, Bitcoin and stuff. That would be great. But maybe first off, I just want to ask you, how have you been lately, and are you enjoying the latest Bitcoin all-time high as well?
Well, I think that the story is about liquidity, and that's what's driving markets and driving asset prices up. Generally, it's not about the economies. I mean, economies have pretty much lost their cycles, and there's no obvious business cycle in any major region worldwide. Effectively, economies have sort of flatlined over much of the last 18 months. So you can't really point to an economic cycle or a business cycle as explanations for why markets are going up. It's purely about the amount of liquidity that is really being thrown into markets. That's why Bitcoin is at a high. That's why gold is not far off its high. That's why probably those particular assets are going to move a lot higher in the future, because we're in a world which is dominated by the need to fund governments. It's a fiscal dominance world, if you like. Monetary policy is a slave to that. And what you're seeing is more and more evidence every day that government spending is out of control in every region worldwide. A number of governments have got significant challenges ahead. And the only way really out of that is to either print money or find sort of more nefarious means of actually raising revenue, whether it's wealth taxes or whatever. It's a world where you've got to think seriously about how to protect your wealth.
Yeah, that's for sure. I mean, I was just discussing with one of my colleagues at the bank that I work in investment management. And so he was sort of also asking the question, we've seen this coupling sort of, as you said, from the financial economy and then the real world economy. And he was like, okay, is this ever going to go back, to a world which everything seems to make more sense, and I think he's not approaching it from this liquidity sort of angle. And that's why it's really something that doesn't add up for him. And so my question would be, is this just a new normal, or are we going back to this world where it's more linked to some sort of business cycle and it feels like there's not that much of a dislocation between sort of the financial markets and the real world?
Good. So it's a great question. I think the answer is we're in a new abnormal, if that's the right way of putting it. It's a world which is characterized by debt and the need to refinance debt. And that's really the key point. I mean, one of the things we've been making the point over the last few years is the financial markets today are not about raising new capital for new projects, new investment projects. It's all about rolling over existing debt. And that dominates financial transactions. Probably 3/4 of all activity in financial markets today is about rolling over current debt. And the fact is that if you take out a loan in whatever form, it needs to be refinanced after, it comes due. Debt probably has an average maturity of about 5 years, which means you've got this sort of constant roll going on in markets. And that's really what we're seeing. And the problem is that if you have to roll over debt, you need balance sheet capacity within the financial system to do that. And basically that balance sheet capacity is what we call global liquidity. It's one measure of it. And so the global liquidity cycle that we see, and you can see a chart of the global liquidity cycle, which we can put up, which is showing the sort of regular movements in the cycle of flows. That is a debt refi cycle. It's basically moving with a similar duration or similar frequency of the maturity of debt, about 5 to 6 years. And what you see is big swings. The last low point was about around October of 2022. And we've basically seen, 2.5 years, 2.75 years of a big upswing in liquidity. It's got further to go probably, but like all cycles, they end. And that's the challenge we've got to start to think about, because without any question, we're late in the cycle.
Yeah, that's what I want to talk about to you as well. Like, where are we actually in the cycle? And you're telling me now we're late in the cycle. So at least, like for my colleague, there's something that I can tell him. Maybe it's not that business cycle related anymore, but there is a cycle. And it is this refinancing cycle that you've been so vocal about as well, and that's what's relevant in driving market prices today. When you said like liquidity is expanding, or has been expanding in the last few weeks, months, was this predominantly because of the weaker dollar that we've seen, that like global liquidity was sort of increasing, or what's been driving this, and where's this balance sheet capacity coming from? This show is brought to you by NewHedge. In a market driven by complexity, insight is everything. NewHedge is a dedicated Bitcoin analytics and intelligence platform delivering cutting-edge analysis, on-chain metrics, and real-time market data. With 200 plus proprietary indicators, live derivatives data, and adoption metrics, NewHedge provides the depth and precision that serious market participants demand. Backed by some of Bitcoin's most prolific investors, NewHedge connects traditional finance with Bitcoin's evolving landscape. Gain your data edge today. Sign up for free now at newhedge.io and get 50% off your advanced subscription with the code SIGNAL.
Yeah, another great question. I mean, I think that it's actually been a number of factors. I mean, one can't dismiss the fact that the dollar has weakened, and that weakness in the dollar has contributed to more global liquidity. That comes in a number of directions. I mean, one of those is that if the dollar is falling, it tends to encourage people to borrow more in dollars, because if you extrapolate the trend in a weaker dollar, you're likely to pay back less in principal if that currency continues to weaken. It's an attractive facet to have a weaker dollar. The other thing is that many countries basically try and target currencies against the US dollar. So if the dollar is weak, their currencies are strong. That tends to damage their competitiveness, and therefore they try and keep their currencies pegged more closely to the dollar which means that they've got to ease monetary policy or monetary conditions to do that. And that's one of the things you're seeing in a number of countries. I mean, I would venture that's why you're seeing rate cuts really across Europe. Certainly that's why you're seeing evidence in Asia and particularly in China of looser monetary conditions. And the Chinese have really gone for it this year. They've injected, in fact, over the last 6 months, something like, or in fact, in excess of 10 trillion yuan, which is close to $1.5 trillion US dollars into their markets. And that clearly is having an effect in stabilizing economic growth in what is otherwise a very lackluster Chinese economy. And what's more, it's beginning to give a bid to commodity markets. So these effects are really starting to come through. So the weaker dollar clearly has an effect. But I think one's got to look wider and say there are other things going on. And what we typically argue is that there are 3 pillars, if you like, 3 pillars behind the pool of global liquidity. One of those is maybe the obvious, which is the US Federal Reserve. And the Federal Reserve has basically allowed liquidity to increase quite substantially in the first half of the year through, various mechanisms. But one of those in particular is the result of the debt ceiling in America. Now, the debt ceiling prevented the US Treasury from significantly increasing debt issuance. And there's been some modest increase in debt issuance, but that's really technical. For the most part, that's been capped over the last 6 months. And as a result of that, to pay the bills of the US government, they've run down their account at the Federal Reserve, which is called the Treasury General Account. By running down that account, including not issuing debt, they are injecting net liquidity into markets. And that's been fairly substantial. I mean, something like $500 billion has actually gone into US money markets as a result of that, and clearly lifted the level of asset prices. So one can't dismiss that. And I think there's an issue or a question, let's say, to raise about what happens in the second half year or into 2026 as regards to these particular mechanisms. So the Federal Reserve has been one factor which has clearly been supportive. Another factor has been the People's Bank of China that I just alluded to. China has injected a lot of liquidity. I cited the figure of 10 trillion yuan, renminbi. That's gone into markets. That's a direct liquidity stimulus. The Chinese are trying to, through every mechanism, to lift their economy and dig themselves out of this debt problem they've got. And that will take a significant devaluation of the Chinese yuan. But as we keep saying, do not think about the devaluation of the yuan against the US dollar. That's not the right benchmark. Think of the devaluation of the Chinese yuan against real assets, because that's what the problem is. They need to basically devalue their paper money against real things, which means that the yuan gold price is set to climb even higher. And that's what we've got to start focusing more and more on. And then the third factor, which is the third pillar, is really understanding how collateral markets work, because something like 80% of all credit today has some form of collateral backing. Now, many people will be familiar with home mortgages because home mortgages are traditionally collateral backed. In other words, you borrow against your real estate from a bank, but actually most other lending now has some form of collateral backing, and particularly in the financial sector. Fixed income securities, particularly US treasuries and German bonds, are used as sort of as the pristine collateral against which to borrow. Now, that particular mechanism is crucial to liquidity generation, and it really rests on, if you like, 2 factors. One of those is stability in the repo markets. And for the most part, we've had that. That sort of encourages more the greater use of collateral and more liquidity. And the other factor is low volatility in the bond markets. Now, this again is a slightly wonkish concept, but the fact is that if you're a credit provider like a bank and you want to give a loan against collateral, you're going to be concerned about the value and particularly the future value of that collateral. So if you've got a very volatile bond market, let's say your certainty in the value of that collateral is diminished, and therefore you'll give a bigger haircut to the collateral. In other words, you'll demand a greater cushion from the borrower in terms of their loans. So in other words, if you're posting a US Treasury security, you might be able to borrow 95% of the value of that. But if you've got a very volatile market in bonds, the credit provider, the bank may say, well, you're only borrowing 90%. So that's a critical element. Now, what's actually happened in the last few months is, despite the fact that bond yields have actually crept higher, volatility has actually come right down, and you can measure that through the MOVE index. And that would suggest that actually haircuts are not impairing the growth of liquidity. And therefore, this is a third pillar which has been positive. So if you look at the factors, number one, the Fed has added liquidity. Number two, the People's Bank of China has boosted liquidity substantially. And number three, what you've seen is the collateral mechanism has actually been pretty well behaved. So overall global liquidity has expanded. And you can see that really if you go back to the chart. Now, the question is, why is that important? And perhaps why should it come to an end? And I think then what we've got to do is to understand the mechanism by which liquidity is used in the world economy and why it's so critical to understand this liquidity debt nexus, if you like. Now, this chart that we can show here, which is looking at the relationship between debt and liquidity in the world economy. And normally there's an equilibrium between the two. There's a balance. And the reason there's balance is that debt needs to be refinanced. In other words, it needs to be rolled over. And you need liquidity to facilitate that roll. And so generally, there is a stable relationship, a stable ratio between debt and liquidity, which the chart illustrates. Now, one of the things that we've seen in the last 5 to 10 years, as a result of the global financial crisis, as a result of COVID, as a result of other policies, zero interest rates and whatever, the debt liquidity ratio has plunged the world. And what that means is there's been ample liquidity in the system, abundant liquidity, if you like. And you can see the annotations we put on the chart, which basically say, well, okay, we're in, if you like, the everything bubble, the cryptocurrency boom, or call it what you like. But that's been facilitated by this ample liquidity relative to debt. Now, a lot of debt has been termed out. In other words, during COVID, when interest rates were near zero, what happened is that many borrowers thought, well, okay, great, we can refinance at zero interest rates for 5 or 6 years, and that would be wonderful. Would save a lot of money. Great news. Trouble is that 5 or 6 year period is now up, and that debt is coming back into the system. So if you look at the chart, what you're seeing is a significant rise prospectively in this projection period in the debt liquidity ratio. Now, it doesn't get to a level which is threatening, because above the dotted line in the chart, what it's showing is that that's where you get tensions in markets. Where the debt liquidity ratio is high and stretched, you get financial crises. We're not there yet, but we're clearly moving out of this benign zone where you have very abundant liquidity below the dotted line. And that's clearly an issue that we need to address. And it's that which is really the concern that we've got looking forward. Now, why is that an issue? Well, the little schematic diagram that I've put up is just explaining why the debt liquidity cycle is so important. And that is basically illustrating the relationship between liquidity and debt, the repo collateral markets, and the whole need to refinance debt within the system. And therefore, if you look at variables that I cited before, like the MOVE index or the stability of the repo markets, that's telling you the risks that we're effectively facing as investors in the system, and why you need to monitor these things in case liquidity rug gets pulled. So that's really the broad situation. Now, I'll just say one more thing before we get on to the asset allocation implications. And that is that if you track the cycle and you look at where we are and you say, well, okay, are there comparisons? The chart I've just shown or put up is looking at the global liquidity cycle vis-a-vis what happened in the 1981 to 89 period. Now, that was a period before where we saw, if you recall, or those that can recall, accords, currency accords. There was the Plaza Accord, the Louvre Accord. And one of the heads up in Forex markets is when you hear politicians talking about accords, what you mean is there's going to be a whopping great currency readjustment. In other words, you're talking about a 20% move in some currency. And that's really what they mean by accord. They've agreed to allow the levels to change. And if you look at, go back to the period 1981 to 1989, that period was one where you saw, in particular, the Plaza Accord, which attempted to get the dollar down. And that was a period where global liquidity expanded significantly. And what I've shown on the chart that you can see is the cycle of global liquidity over that period, 1981-89 period, and compared that with the 2019 to 2027 cycle. And it looks as if it's moving almost exactly. So what they're saying is we got to be wary about some upcoming peak in the cycle, probably around the first quarter of next year. Now, we originally thought that the cycle would peak later this year, but because of various actions by central banks along the lines that I've previously alluded to, maybe that's being pushed out a little bit. But, we're talking about months rather than years of delay, I think.
Yeah, I mean, that's so neatly explained, because in the end, that's my follow-up question, because like, as you said, you just explained how everything should be coming to an end, so to say, and then also the signals that you can watch for. You really like when this refinancing is knocking on the door of everyone. But then my question sort of is like, yeah, probably central banks and monetary authorities, fiscal authorities, they have so many aces up their sleeves. And the question is, even if we should see some of these metrics signaling that there is some stress in the system, they would probably just supply whatever it needs in the end, so we get through this again and it can once more be extended, sort of. Don't you think that this will be the case again?
Almost, yes, almost 100%. I think that they're in the business of kicking the can down the road. They have to do. We're in a debt-driven economy, and credit's clearly important. I think, you can sort of raise the hypothetical question, which is sort of more philosophical than realistic. But it says, if all the debt in the world was paid back, so there was no credit system, would capitalism exist? Well, it wouldn't, would it, by definition? I mean, you basically need debt in the system. The trouble is we've got lots of it right now, and that's becoming somewhat unmanageable. And effectively, the only way that you can get rid of debt or excessive debt in the system is to create liquidity. In other words, you create a monetary inflation. And we've seen this so often through history. What happens is that by some means, fair or foul, central banks, governments create more liquidity. And that's what you've got going on. Now, if we single out the US, which is not necessarily the main culprit, but it's a very good benchmark to think about because the US is so important in the financial system. What you've got going on in the US is a debate right now, not just about the size of the Federal Reserve balance sheet, but actually more particularly about how they actually issue, or how the US government issues debt. Now, one of the things that Scott Bessent, the Treasury Secretary, made a point of noting when he came into office was how profligate and irresponsible his predecessor Janet Yellen was in funding a lot of the US deficit at the short end of the market. In other words, to issue Treasury bills and short-dated government debt. Now, that's a problem because it really holds the US government hostage to movements in short-term interest rates. And it also requires interest rates to be kept low, and maybe kept low by a compliant Federal Reserve. And that's one of the reasons that Chair Powell is continually being hammered by President Trump to say, this guy's an idiot. He needs to get interest rates down as soon as possible. Well, he needs to get interest rates down because it would reduce directly the interest bill of the US government. And that's why there's such a pressing need. But if we hold this thought about the implications of short-dated debt financing, it's not just about the interest cost, it's about the long-term monetary implications. And the reason being is that if you issue, a lot of Treasury bills, what happens is that banks tend to buy them because banks like Treasury bills. They like very short-dated government debt because it matches their liabilities more precisely, because they're taking in bank deposits. Bank deposits are growing fast because of fiscal largesse. In other words, governments are spending so much money, people's bank accounts are going up. But those bank accounts, that bank deposit needs to be offset on the other side of the bank's balance sheet. And they tend to buy government bills, short-dated government bills, to offset that because they effectively, in parlance, duration match. So they're big buyers. The problem is if the banks buy any form of government debt, it is called monetization. They're printing money, by definition. And this is what is going on now in the US system. And what's more, the British government, the Japanese government have also said, hey, look, we're going to start thinking about issuing very short-term debt too. Well, this is a problem globally. So what's happening is you're seeing this shift towards monetization. And it's little wonder that the gold price and Bitcoin rates are near all-time highs. This is purely printing money. This is the danger.
Yeah, exactly. No, I want to come back to this for sure. Yellenomics and how Bessent is maybe even harder pressing down than Janet herself, but maybe without flip-flopping too much, I want to come back to this one question about the collateral topic, that you were addressing, and sort of, because that's something that I've been seeing as well within the bank that I work, and it wasn't clear to me in that extent, but like a weaker dollar or a weaker fiat currencies in general, I mean, they also bolster collateral values in that sense, because like the weaker the dollar, sort of the more higher the real world assets go. And is that also a way how then liquidity can sort of be amplified again? Because I just picture people, clients of our bank, they taking a Lombard credit, they're borrowing against their assets, and the higher their nominal value is, the more they can sort of borrow. And that's then also, again, something that really amplifies liquidity. Is that sort of the mechanism, or is there something else at play?
No, that's part of the mechanism. And if you've got foreign assets that you're bringing, and those foreign assets have been elevated by changes in currency, then that's clearly a source of more collateral. I mean, there's no question about that. And broadly, the great danger in the financial system is that you get this sort of virtuous circle whereby rising asset prices create more collateral. More collateral gives you borrowing capacity. Borrowing capacity creates liquidity. That drives asset prices up more. And so you basically get a blow off. And there's no question that we're in that realm. The question is, how fast are we moving? And are we moving at a dangerous speed? And that's why I think you've got to understand how the cycle is unfolding. Actually, I put up a chart again, which is looking at what we call the asset allocation cycle. And I think the point that, we've all got to start to think about here is, where are we in the cycle? What stage are we? Is it 1 o'clock, 6 o'clock, 9 o'clock, or whatever the right analogy is? But I think if you look at the cycle, and you can, maybe I ought to explain the way it works, is that actually in that diagram I'm showing, there are, if you like, two sections. The right-hand side is looking at the investment regimes, as we call them. So we think about calm, speculation, turbulence, rebound. And on the left-hand side, I've shown the asset classes that tend to perform at these different points in the cycle. Now, generally speaking, if you're in an upswing of the liquidity cycle, particularly in the middle part of the upswing, equity markets do really well. And that's the stage we've been in. As you start to move towards the peak of the cycle, commodity markets tend to get a bid. And I would argue that's more or less what's going on now. As we start to inflect downwards, in other words, as the liquidity cycle tightens, you basically want more cash or more defensive investments. And then when we get towards the trough of the cycle, you want government bonds. And then the cycle restarts with equities again. Now, if what you can do is think about where we are in that cycle, and you can try and associate the performance of different asset classes with the positioning in the cycle. Now, as I said, equities tend to outperform during the upswing they have. Commodity markets are beginning to get a bid. Well, that's consistent with where we are in the cycle. And then I've also embellished on that chart what the yield is doing. And typically, what you would see in an upswing is a steepening yield curve. And as you get towards the peak of the cycle, you basically get a bearish steepening. And that's more or less what we're getting. So it looks a very normal cycle. And then you do a further embellishment by saying what industry groups are actually performing. And again, I've shown those annotations on the chart in red. And what this is saying is that during a period of strong upswing in the cycle, it's normally cyclical growth areas, things like technology, which outperform. As you get nearer the peak, you tend to find things like cyclical value, which are, basically heavier industry, things like resources, financials tend to do well just before that stage. And that's more or less what we've had. So I think if you start to look at the performance of asset markets, what you find is that they're not related in any way at all to the real economy, because we haven't got a real economy cycle, but they're actually related exactly to the liquidity cycle. And that's what's driving everything right now. And that's basically, the story that we're telling. So it looks like it's a normal cycle. It looks like we've got certain ones to go. We are in a stage of later cycle where commodity markets and things like cyclical value stocks should outperform. And I think that's more or less what we're getting. So we've got to be wary about things, looking at things like, what is the health of the repo market? What is the health of the bond markets? Are you getting a lot more volatility in bonds? That would be a negative, clearly. Are you starting to see commodity markets surging? That's a sort of a late cycle sign.
Yes, I see. No, but then what you're telling me really is that these terms that you also help popularize, not QE, not yield control, not yield curve control, yield curve control, like these things, these playbooks, that were really popular in 2024 and people were reciting them, they are still very much in play. And fiscal and monetary authorities all around the world are still following these playbooks. And as you said, maybe increasingly so, with other governments now also want to go issue government debt at the short or at the ultra short end. And so, yeah, as you're explaining, this is still going on, and there seems to be no way or sort of idea that this could change anytime soon, right?
I think that's right. I mean, look, how do cycles end? And I think that you could say that cycles end in broadly speaking, this is a rough generalization, but in sort of two ways. One is that you get an inflation shock coming through and central banks tighten. And that's sort of, in many ways, the classic business cycle effect, where a tightening monetary policy causes the cycle to turn down and asset markets perform badly through that period of tightening. That's what we're used to. And then when the economy dips into recession, central banks ease again and the cycle restarts. And that's a familiar cycle, and I'm not decrying that because that can occur at different times. But there's another possibility, which is basically when you get a fiscally driven world where effectively governments kick the can down the road until they can't. And they effectively stub their toe, to continue the analogy, on a funding crisis. That's meaning that the bond markets scream and say, look, we're not going to finance this anymore. Interest rates rise, or it becomes difficult for them to fund, and therefore you get a crisis of the state. And that's why markets would take a tumble. And it's that sort of financial crisis that maybe we're moving towards. There will come a point where the so-called bond vigilantes say, well, it kind of no more unless yields are much, much higher. And that, I think, is the concern we've got. And I think on that regard, one's got to look pretty carefully at countries like Japan, which were kind of first down this road of fiscal largesse, printing money and whatever, and look at what's happening to the Japanese bond market. And it's that which I think is going to be a bellwether, because if Japanese yields rise, they could be a sort of cascade effect or domino effect on the world, given the fact that Japan is a major source of world savings. And if Japanese interest rates at the long end of the bond market start to go up significantly, then I think you've got maybe a knock-on effect worldwide, which will then start to expose the inability of Western governments to actually fund themselves domestically. The US would run into a problem. Japan, we know, is a big holder of French bonds. That could be an issue. Maybe dear old Britain, which is always a calamity or disaster in these occasions, ought to be looked at pretty closely, because you've got a socialist government who seems not to understand anything about financing and budgeting. And that is spending and hoping for the best. And then they're going to start, increasing the tax take. So good luck with that, because it just won't work.
Yes, I see. Interesting. You hinted at it yourself as well, in terms of the debt ceiling. This has been lifted in the US. Now, I think, as far as I'm informed, increased by this 5 trillion through this passing of the One Big Beautiful Bill Act, and so, like, what is going to happen now to the TGA? Obviously, yeah, they now have the leeway to sort of increase it again, but is this going to have a huge effect in draining liquidity again from the system? I think some people are fearing that this might be coming our way. How do you see that?
Well, the short answer is that it could. Will it? I'm less certain. I can't see why they would want to suddenly rebuild the TGA. Clearly that's the target. It says in the latest documents from the quarterly refunding announcement that they're going to go back to 850 billion. Well, given the fact that the TGA is currently 311 billion, that means they're going to prospectively take 500 billion out of money markets. Now, that is a big ask. And if they did that, you would see spikes in repo rates without any question. So that would be a disaster. I think that would be they're going to be forced to tread carefully, Now, if you look at what's going on, you can see in terms of weekly operations of the Federal Reserve that they seem to be very carefully targeting bank reserves, which is a number they can fix. And they seem to be targeting that on about 3.3 trillion. Now, if that deviates significantly, I mean, are they up or down? But clearly down is the question we've got to ask here. That has a lot of implications for asset markets. And so we've got to watch that carefully. But you'll see those signs daily looking at the repo market spreads if they start to deteriorate. They were deteriorating through last month to some extent, and there was actually, although this is getting into the weeds, there was a big jump or a sizable jump of about 20 billion in the standing repo facility, which hadn't really been used for a long time on the Fed balance sheet. And that was a pointer to say that liquidity conditions were getting tighter in US money markets. And therefore, at the margin, the Fed had to supply new liquidity in emergency. Now, I think the bottom line here is that the Fed is still going to continue to target liquidity. They want ample liquidity in markets. I mean, after all, that's why they're changing their funding policy. That's why they're issuing a lot at the short end, because they don't want to dump a lot of long-dated treasuries on the market, destroy liquidity and cause yields to go up. So they're clearly managing this situation. So I'd be very surprised if they let the TGA rebuild along the lines that they're suggesting. But it may go up to some extent. I think that's fair enough. What I think you also got to start to look at, and there was a speech yesterday by Governor Waller, Fed Governor Waller, to this effect, is what's going to happen to the bill market. And he was alluding to the fact that the Fed is going to itself buy more bills. And what this suggests is it endorses the fact that, or underscores the fact that the Treasury is issuing lots of bills. Now, if the Treasury issues lots of bills, I come back to the point. This is effectively monetization, or it means monetization, because banks that buy them. And that is printing money. And that always ends badly.
Yes, exactly. Yeah. I read this interesting sort of paper just recently, or I skimmed through it, and I think it was by some economists at the Fed. And in that paper, they explicitly had this line where they said, in the abstract, it says, we find that an across the curve strategy of buying securities in proportion to outstanding amounts generates somewhat less income volatility than a laddered portfolio, those still more than a barbell portfolio. And it feels like to me that they are really sort of outright also preparing the market, or rationalizing the purchase of these bills so that they don't spook the market again,
Exactly.
once it happens. That's probably it, right?
Exactly right. I think that's exactly the point.
Yeah, no, it's interesting. I mean, in terms of like deliberately targeting US banks' reserves to smooth out the refilling of the TGA, how can they exactly do this? I mean, I've heard that sentence before, but I still can't really wrap my head around how are they doing this, like targeting US bank reserves?
Well, I mean, that's what a central bank does. I mean, the central bank determines the level of reserve, the overall level of reserves by its activities. That's not something banks can themselves control. That's given by the monetary authority. An individual bank can control its own reserves, but the system as a whole cannot. And therefore, that's really in the gift of the Federal Reserve, and that's what happens through its balance sheet operations. That's for sure. I think that, as I say, we've got to start thinking more generally of monetary policy being conducted by the Federal Reserve and by the US Treasury together now, because if the decision is to issue a lot more short-dated debt, that is effectively a liquidity injection. And I think you've got to think about this in abstract terms, that, what is liquidity in generically? It's basically the value of an asset divided by its duration. And if you shrink the duration or maturity of the stock of debt, you are by implication increasing the liquidity into the private sector. And that's ultimately what they're doing. And that is something we've got to think about, not just in the US, but actually globally as well. All these central banks or debt management agencies are going to start thinking more seriously about short-dated debt. It's not a great solution for sure, but it's a convenient one.
Yeah, and I think it's being acknowledged as well, because in that same paper that I referenced, I mean, they even have the line and they write this outright, as the United States issues more debt, these changes are likely to put upward pressure on yields and term premiums and generate greater market volatility. Higher volatility could in turn reduce the allure of the US Treasury as a safe haven. And that's so interesting that you can actually read this in a paper, by economists that are ultimately employed by the Fed. So there's sort of seeing these signs are being written on the wall as well. So it's not just you and others that are pointing this out. I think they might not be able to say it outright, and really Jerome Powell maybe has to mince words, but at the same time, yeah, it is being acknowledged, I would argue.
Yeah, as I say, I mean, I think this whole episode explains why gold is at an all-time high or pretty close to it, why Bitcoin is, and why the Swiss franc is, catching a strong bid. I mean, it's not rocket science. It's just the fact that they're undermining the integrity of their paper money. And at the end of the day, what really matters to the U.S. Federal Reserve and the U.S. Treasury is not the inflation rate, not the business cycle. It's basically the sovereign debt market. They want the integrity of the government debt market, the Treasury market, to be held firm.
Yeah, I see. But to your point, I mean, undermining the integrity, of the dollar and fiat currencies. I'm also really curious to get your thoughts on these various attacks, by the U.S. president himself, Trump, attacking Jerome Powell. Then we have some other attacks. I saw on X just recently this guy, the U.S. Director of Federal Housing, William Pulte. He was sort of attacking Jerome as well. Then the Fed is being attacked that they way over budgeted their sort of renovation of its headquarters. And all these attacks, I mean, it really feels like to me, and that's what we're hearing here in Switzerland as well, that the certainty, the legal certainty, the certainty of the rule of law in the US is rapidly declining. And these things obviously don't help, because like if Jerome Powell was really impeached, so to say, and he would have to go, I mean, before his official term ends, I mean, yeah, that would just not be really positive in that sense. Even among Bitcoiners, usually it's like, this is all going to happen, but it feels like it doesn't feel so healthy in that sense. Or what is your feeling here? Like long term?
Yes. I mean, I agree. I don't know if I've got the solution or can explain it, but I think that this is definitely going on. I mean, a lot of people close to Trump don't want the Federal Reserve. They see the Federal Reserve as an impediment, and they'd like to get rid of it. Now, that is a sort of fanciful and slightly ridiculous notion, because we need central banks because of the whole complexity of the financial system. So, it's just a fact you've got the Federal Reserve because you've got a complex financial system, and there's no question about that. Now, I think that if you start to roll forward, there's a lot of, into 2026, there's a lot of, let's say, potential for more disruption, not just the ending of Powell's term, which is inevitable. The question is, who is going to take over? And, Kevin Walsh is one, but it could even be Waller currently at the Fed. I mean, there's a number of names that are in the hat, and it's likely that those people would be more accommodative of Trump in terms of lower interest rates. That's a possibility. Although I would say, if you go back in history, those episodes have not always been that certain. So when presidents have replaced Fed chairs with what seemingly are more benign ones, it actually turns out that they're not in the reality. So I think nothing is guaranteed here. And I think the independence of the Fed still seems to be sort of sacrosanct in many cases. But I think, we've got to start thinking about outside the box as to what could be done or what could happen. And one of the things that has been mooted is what happens to the US gold stock. Now, this is something that Bessent has ruled out for now, but it's such an obvious factor that they could revalue the stock of US debt. Revalue the stock of US gold and give them a windfall gain in terms of not having to issue Treasury debt in the future. Given the fact that US gold is held at $41 an ounce rather than $3,500 or whatever the current figure is, that would be a big jump. Be $1 trillion windfall for the US Treasury. And these things could happen. And one of the reasons that I'm citing 2026 is it's 250 years since the establishment of the United States. And it's not inconceivable that Trump may do something along those lines, a sort of liberty bond perhaps, maybe linked to gold. I mean, that's something that some people have mooted. So let's say, never rule these things out. And it could well be that, what he wants to do is to undermine the credibility of the Federal Reserve and actually somehow put the US back towards some sort of gold standard. And I say some sort because it clearly won't be one for one, but it could be some element of gold is in the monetary system. And I think it's very important to also throw into this that the Genius Act ruled out a central bank digital currency. And the fact that it ruled out explicitly, I think, is an important fact to think about, because they clearly want stable coin, private sector stable coin, to be an established pillar of the US financial system or global financial system. And it's important, coming back to the bill issuance fact, because who are big buyers of US Treasury bills? Stablecoin issuers.
Yeah, exactly. Yeah, I want to talk about this as well, but maybe just quickly. I mean, the thing with the revaluing that you were talking about of the gold stock is, I think, something that Luke Roman and others have been referencing as well. And in the end, I mean, it makes a lot of sense to me. But I think my point earlier was sort of, yeah, it feels like Trump is really walking this fine line, and the entire administration of maybe even throwing a wrench into the works, and this could really be also, as I said, a fine line where it's careful what you wish you for, by really going against the Federal Reserve and sort of even demolishing it altogether will probably be on the very far out spectrum, so to say. But still, I mean, it's just what we've been hearing also in Switzerland in the financial sector, that like legal certainty in the US, even though they think like they're now really MAGA, everything is going well, I feel like it's going sort of also the opposite, at least from what we're hearing, by really going that hard against these established institutions. So it's just going to be interesting. And it's interesting that some Bitcoiners, on X, even though it's sometimes an exaggeration, but they even celebrate this and cherish it, and it's always be careful what you wish for, because it's the same with the interest rate thing now as well. People are like, okay, Bitcoin is already pumping, but the Fed hasn't even cut rates. I think once the rate cuts will be here, I'm not sure if everything will be priced in already. And I think you have a different view on rate cuts and interest rates altogether anyways, but it's always this, what's being priced in already. And obviously on X, there's a lot of things floating around. Yeah, it's just interesting what's going on, sort of.
I think that's right. I mean, on the interest rate question, I do think that the US probably has to cut interest rates. I mean, if you look at the pace of the economy, the underlying pace of the economy, clearly it's slowed down. And I think that there are rate cuts which are probably warranted. And it's clear that the Federal Reserve is holding back because of the uncertainty over inflation or prospective inflation later this year when the tariff bites. That inevitably, that's a supply side shock, which must adversely affect both inflation and the growth of the economy. So I think in that regard, the Federal Reserve is probably just being prudent. But if you look at the data, I think they definitely should be cutting interest rates through the latter part of the year. The markets may enjoy that.
Yes, no, for sure. Maybe the last topic I really want to turn to is the stablecoin topic that you also mentioned already, so the Genius Act. And so what do you make of this Genius Act that has just recently been passed in the US?
Well, I think it's okay. It's clearly a very interesting act. And I think that, on the face of it, it offers quite a lot. I think the actual implications are going to be complex, and I'm not fully sure that I've sort of thought them through properly. But, there are a number of issues which really come out of this. And one of them, let me just sort of run through, which I think are sort of the relevant points. The first thing is that it provides an avenue or an opportunity for the US government to fund itself. That's for sure. Because regulated stablecoins will have to own a lot of government securities, and they will have to own a lot of short-dated government securities. And, we can debate how much, but it's probably in practice, they're going to be something like 90% backed by Treasury securities in some form. So this is actually a significant funding opportunity for the US Treasury. And if people's expectations of the growth of stablecoin, which are currently about 250 billion, but people have said they could easily go to 2 trillion, 3 trillion, that's a lot of funding that would help the US government without any question. Now, it's probable that they would displace money market funds, and so money market funds would not be buyers of treasuries, and so it's a little bit swings or roundabouts. But one could assume that there's actually a net benefit overall, particularly if stablecoins are used internationally. If you go down this route of looking at the international implications, it's because the US is sort of first off the blocks here with these stablecoins. Things like Tether and Circle could be held more widely in the international arena. And if you start thinking about this, even though they don't pay interest, which is, kind of a moot point here, they could still challenge the role of international currencies, particularly the euro. So in many cases, if you get a very strong development of the US stablecoin industry, it's the euro which, ironically, could be one of the casualties. I'm not saying, a wholesale, but it could dent the performance of the euro if you start to get stablecoins being used. Now, there've been a lot of wild talk about stablecoin as replacing or something akin to the eurodollar markets in the 1970s. And for those that are not familiar, the eurodollar markets were basically offshore pools of dollar deposits that were unreserved and basically had a very big credit multiplier. And so they allowed dollar liquidity to grow phenomenally in the world economy through the 70s and 80s. And the eurodollar markets, which are, they've been eclipsed since, but they were a major source of liquidity provision. Now, forget that, because stablecoins are not in that same position. They're not banks. They cannot create credit per se. They can issue some amount of credit, but they're not net credit providers. What stablecoin do is to expand liquidity, in the system. In other words, they're increasing the supply of short duration assets, but they're not net credit creators. You still need banks to do that. So some of the wilder expectations are not there. Nonetheless, it's still a positive, I think, both for liquidity in the world economy, because clearly the more stable coins there are, the more ability the private sector has to transact. And that will likely come through, in particular, things like Bitcoin, because stable coins are an integral part of that whole universe. So I think that it's generally positive for that area of the market. I think in terms of the integrity of the dollar and the wider financial system, these are actually big positives. And I think it enhances the role of the US dollar. It enhances the role of the US financial system. Partially what we've been saying about the loss of confidence because of Trump's statements. But the clear evidence is that if you start to drill down and look at things like relative term premium on US bonds, vis-a-vis German bonds, vis-a-vis Japanese government debt, whatever, there is absolutely no evidence that the integrity of the US bond market has been dented by what's happened in the last 6 months. US here, if anything, have actually fallen relative to the Bund and relative to the Japanese government bond. And if you look at more complex calculations, such as what academics call the convenience yield on US treasuries, actually that convenience yield showing the safe haven value has actually gone up in the last 6 months, not come down. So there's no evidence at all that the US dollar has lost its safe haven qualities, as the media like to tell us, but that is simply wrong. Why the dollar is weakening is because of shift in the monetary fiscal policy mix. Purely the fact that I think it's because the US economy is slowed vis-a-vis the rest of the world, because the fiscal program under Biden was slowed down temporarily when Trump came in. And secondly, because the Federal Reserve has injected so much liquidity in the last 6 months as the debts have been imposed. So one would expect, looking forward, some stability in the dollar, over the next 6 to 12 months.
I see. I mean, the question that I'm having when it comes to stable coins and then also the stability of the dollar, everyone it's received so positively right now, also by the administration, they're thinking like, okay, this is going to be able to buy up all the short-term debt and stuff. And so my question, or the question that I'm asking myself also, is, isn't there maybe some negative side effects as well? I mean, you said stable coins could maybe at some point even challenge banks, or they could challenge money market funds, and then maybe the US monetary framework as such could transform into something new. And if it's transformed, this maybe has some hiccup potentiality and stuff. Are you seeing any risks on the horizons with this as well? That the system in and of itself could even be disrupted?
Yeah, it's a very good point. I mean, I sort of wrote a piece, I think, on Substack, which was saying that if you draw an analogy with stable coins, they're not akin to the eurodollar market creation in the 70s. They're much more akin to the establishment or the charter that established the Bank of England back in 94, which basically was a way of funding the then British government. And then British government basically had wars to fight, and the Bank of England, which was then a private bank, was given its charter to basically fund the government. And you can think about stablecoin in that regard. Now, you can think of it in that regard really from this angle as well, is that, as I said a few moments ago, stablecoin don't create credit, okay? Banks create credit. So if banks are losing deposits to stablecoin issuers, banks are then losing their ability to create credit. So it's entirely possible that if you saw a huge growth in stablecoin, it would be equivalent to what you can think of, or what economists would call a gyro banking system. In other words, effectively, you just lend what you take in, but you don't create any net credit. There's no credit multiplier. Banks are unique in the system insofar as that they can create credit out of nothing. So in other words, if you're a bank, I can simply lend you money and I can create it mystically out of thin air, right? No other entity could do that. And that's simply because bank deposits are deemed legal tender. Now, that's a facility that only banks have. Now, if you're taking away that bank deposit from a bank and giving it to a stablecoin issuer, you are effectively, per se at least, reducing the credit multiplier within the economy. And now, that could mean much slower credit growth. But therefore, on the other side of the ledger, it's saying, well, actually, if the government is the credit creator, then it's the government that is really driving that credit system. And so come the whole point. But what this is doing is basically emphasizing the importance of the state in the modern economy. And that's what we're getting down.
I mean, that's so fascinating to me because like the example that you reference, with the charter of the Bank of England, the book that I have back here, on that Bitcoin book, we're expanding this exact historic establishment, an emergence of the Bank of England and how it actually was there to finance the king in Britain or in England, so to say, And if I extrapolate this further into today, it really feels like this system that we're in now, with fiscal dominance. Everyone is talking about MMT, about the state being the credit provider, being really having to take up the brunt and take over the baton of everything, This whole thing with stable coins, and as you said, like challenging the banks and maybe then also diminishing their quality or their ability to do private lending and in that sense, credit creation, that all adds up to me and is sort of one sort of conclusion that we had in the book is that is MMT and really like state being more prominent in the economy is really the end game, of fiat, and this all comes together in that sense. Now that you're also telling me this, there are all these puzzle pieces where you could at least make the argument, that we're moving in that sort of direction, and it's just fascinating to see. And obviously, the implications are not yet clear, but just very, very interesting.
I think that's right. I mean, we've got MMT, although everyone denies it, but that's exactly the policy they're following. And I think the sort of benchmark was really what Japan did. I mean, a lot of politicians or policymakers are looking at what the Japanese did in the last 15 years and say, well, hey, why can't we do that? Didn't have any bad effect, did it? And so they think that there are risks to be taken. But as we know, history shows more broadly that it always ends badly.
Yeah, that's a great point. I mean, in the end, this is really what I think comes down where it comes to the investor. Like if we know that the world is moving into that direction, and stuff like MMT is actually really describing the reality, and maybe things like stable coins and everything are just pushing the world more towards this reality. I mean, we're back to square one or to the beginning. How to think like an investor. You really have to be aware that monetization will be the talk of the town and will keep on being the case. And that's why, you have to sort of think about these new modern assets differently and sort of, I think you also had a recent piece, and that's maybe like my last question to finish on how to value these modern assets, because a lot of people that I see also at the bank and so they're still struggling, with valuing these modern assets because they're saying, they don't have any intrinsic value, so that's why I don't want to touch it. But you feel like you have a way to value them, and maybe if you could finish up on this and let people know how they should really approach these assets in times like these, that would be great. Yeah,
okay. I mean, I think the way to think about it is that you've got. I mean, the first thing to say is that in my view, this is not financial repression, which a lot of people try to label it. It's actually bigger than that. It's a lot more serious. It's monetary inflation, and monetary inflation is a much different state. And we're in a world of monetary inflation where you've got to think about how you deploy your assets, and it's not in a 60-40 portfolio. You've got to have dedicated monetary inflation hedges within the portfolio. Now, what I'm going to do is maybe end with a chart, and if you look at the chart that I'm putting up here, it looks at how you value different assets, and the benchmark is against inflation. Now, what I've drawn on that diagram is two lines. There's a sort of bell-shaped curve, which is the valuation of equities, and there's a slope which runs down from top left to bottom right, which is bond valuations. And what that says is that in an environment where you've got very low inflation, the valuation of bonds is obviously sky high. And if you start to move towards deflation, bonds look even better. But as you start to move towards a higher inflation environment, the valuation of bonds starts to drop very rapidly. Equities are very different. Equities basically have a sweet spot in valuation, which is around about 2 or 3% inflation. And what I've shown on that diagram is where different economies are. And you can see that the US has sort of moved more to the right. So it's beginning to see a devaluation or revaluation lower, I should say, vis-a-vis other markets like Europe or Japan or even China. And you can see that sort of sequencing moving through. Now, what I haven't put on that diagram, which you've just got to envision, is what's happening to real assets. And real assets are the mirror image of the bond line. And what that line would tell you is that as you get higher and higher inflation, the valuation of real assets starts to go up significantly. As I say, it's completely the opposite of what would happen to bonds. And therefore, if you put into that category prime residential real estate, you put into that category gold, and you put in Bitcoin, that's the answer for asset allocation. If you believe there's a lot of monetary inflation coming, and that's really the warning, not here now, but it may be coming in the next 5 to 10 years, then you've got to invest accordingly. And that's what we think. You've got to change a 60-40 portfolio and hold in that dedicated monetary inflation hedges. By all means have equities, but you need large cap equities that have got pricing power. And that's what tends to do well. You get very high inflation, equities won't work, but a moderate amount of inflation they will, but you want these dedicated monetary inflation hedges.
Yes, that's great. Exactly. Well said, Michael. Thanks a lot for your time. Now we've gone over an hour. That was much appreciated. And I just want to remind people again of your newsletter that you have on Substack, Cross Border Capitals. Great stuff. So everyone should check it out.
Called Capital Wars on Substack.
It's Capital Wars. Yes, exactly, on Substack. And on X, I think you're Cross Border Capital. That's how it
Cross Cap. Yeah,
it is. Exactly.
Research is crossbordercapital.com.
Great. Cool. Thanks a lot. Much appreciated, and hope to talk to you in the future again.
Great. Look forward to it. Thanks again.
Bye.